In every century, people believed stability had finally been solved. Banks felt permanent, currencies felt reliable, and markets felt rational. We tell ourselves the same story whenever systems seem calm. And then, almost without warning, something shifts. What looked solid begins to thin, what felt permanent becomes conditional, and yet, not everything disappears. The real mystery isn't why systems collapse. It's why certain forms of value keep surviving when they do. In 1928, American investors believed modern finance had eliminated chaos, credit was organized, markets were sophisticated, and prosperity felt engineered. Then prices broke, confidence evaporated, and fortunes built over decades dissolved in months. In 1719 Paris, the public believed paper shares represented limitless opportunity. Crowds gathered, conversations revolved around future gains, and optimism became social currency. When the scheme failed, wealth didn't just fall, trust fractured. In late 19th century Argentina, foreign capital flowed steadily into railways and bonds, as international investors believed integration meant protection, and global meant safe. When funding reversed, the structure weakened quickly, and assumptions collapsed faster than infrastructure could adjust. Each era believed it had matured beyond instability, but collapse did not arrive as a forecast. It arrived as a break in expectation. Stability never announces its expiration date. It simply feels normal until it isn't. During calm periods, wealth drifts further from the physical world. It becomes numbers in ledgers, claims on distant output, or contracts promising delivery later. Abstraction makes systems powerful. It allows capital to move quickly and expands what feels possible, but abstraction stretches trust. A lifetime of savings can become figures on a page, entirely dependent on belief. In Weimar Germany, paper currency functioned until confidence thinned. In 2008, complex securities were precisely valued until no one wanted them. When trust weakens, numbers stop behaving like wealth. Pause for a moment. In every crisis, something curious happens. Even as financial claims contract, exchange does not stop entirely, and not everything falls at the same speed. Economic collapses look different on the surface. Sometimes banks close, sometimes currencies weaken or markets freeze. But beneath the headlines, a pattern quietly repeats. Financial claims shrink, paper wealth thins, and promises are rewritten or erased, and yet people still trade. They still store value, and they still protect what matters most. If wealth were only what financial systems define, collapse would erase it completely, but history suggests something more precise. When systems fail, value does not vanish equally. Some forms weaken quickly, while others persist. That asymmetry is not random. It appears again and again. If every crisis destroys what people trust most, why do the same kinds of value keep surviving, again and again? If you're someone who likes understanding history through patterns, not predictions, this is exactly what we explore here. If that sounds like you, consider subscribing. Economic collapses rarely begin with empty shelves. They begin with hesitation. A lender pauses, a buyer waits, a bank grows cautious. The system still operates, but differently. Credit tightens quietly, questions circulate privately, and confidence becomes conditional. People stop asking, "What is this worth?" and they begin asking, "Will this still hold tomorrow?" That shift is small, almost invisible, but it changes everything. Crises do not shatter systems instantly, they test them. In stable times, prices feel decisive. They tell us what something is worth and coordinate millions of decisions without conversation. During stress, that authority weakens. In 1929, stocks did not simply fall, they became uncertain. In 2008, entire asset classes stopped trading because no one trusted the numbers. Value and valuation are not the same thing. When liquidity thins, price becomes negotiation, not signal. A house might be worth a certain amount, but if no buyer appears, what does that number mean? Crisis exposes the difference between a quoted price and a usable one. Modern wealth rests heavily on promises. Deposits promise redemption, bonds promise repayment, and shares promise future participation. These promises work because we assume systems will enforce them, but under pressure, enforcement becomes uncertain. Governments suspend convertibility, banks restrict withdrawals, and contracts are renegotiated. Legal claims begin depending on political survival, and political survival depends on stability. Paper strength reveals its limits. What seemed secure because it was written down now depends on forces outside the contract itself. Liquidity feels invisible in normal times. You assume you can sell, you assume someone will buy, and you assume there is always an exit, but crisis removes that assumption. A shop owner may hold inventory, but no customers walk in. An investor may own shares, but no buyers bid. Ownership remains, but convertibility does not. This is where abstraction feels different. It is not the fall in price that destabilizes people first, it is the inability to act. Liquidity is confidence made visible, and when it vanishes, the structure weakens. This is where the pattern becomes clear. Crises do not randomly erase wealth, they filter it. They compress what depends entirely on confidence, they strain what depends on coordination, and they expose what depends on leverage. Ultimately, they reveal what can function without perfect conditions. The test is not moral, it is structural. When systems tighten, what remains exchangeable? What remains necessary? What remains usable when trust thins? Across centuries, the same sorting mechanism appears. Crashes are not chaotic erasers, they are stress tests, and stress tests produce consistent results. If history keeps applying this pressure over and over, shouldn't the forms of value that survive start to look familiar? When systems strain, behavior changes quietly. In the early years of the Great Depression, department stores emptied first, but grocers did not. In late Roman cities, imported luxuries disappeared long before grain shipments did. In modern currency collapses, restaurant tables clear, but bakeries still open at dawn. Exchange does not stop, it concentrates. What continues moving is rarely glamorous, it is required. Under pressure, markets reorganize around what people cannot postpone. As confidence thins, weight becomes risk. Across centuries, portable forms of value reappear, not because they promise growth, but because they promise mobility. During medieval banking disruptions, merchants shifted from letters of credit back to metal carried by hand. In episodes of hyperinflation, jewelry leaves drawers and enters trade. In political upheavals, families convert savings into objects that can cross borders unnoticed. Portability becomes quiet leverage, not profitable but transferable, and in uncertain moments, transferability can matter more than return. Financial claims rely on someone honoring them, but fields do not, workshops do not, tools do not. After wars in Europe and Japan, factories with intact machinery mattered more than vanished bank balances. In agricultural economies facing instability, land that produced food retained bargaining power even when currency faltered. Production does not depend on sentiment. It depends on capability, and capability survives confusion longer than confidence does. Some things reveal their value only when threatened. Shelter is one, energy is another. During financial shocks, markets fluctuate, but homes remain occupied. Utilities struggle, but demand does not disappear. A family may delay purchases, but they do not delay heat. They may renegotiate debts, but they do not abandon water. Certain needs resist abstraction, and when abstraction weakens, those needs regain clarity. There is another pattern less obvious. During periods of severe instability, small businesses often reappear faster than financial institutions, not because they are insulated, but because they are adaptable. A mechanic can change prices daily, a farmer can barter, and a carpenter can adjust materials. Flexibility itself becomes an asset. In Argentina's crisis years, informal exchange networks expanded before formal credit returned. In post-war economies, skilled trades reestablished activity before stock markets stabilized. The capacity to adjust, not scale, becomes valuable. This is easy to miss. Large structures dominate during stability, but small, flexible ones often recover first. Across centuries, crises do not invent new hierarchies, they simplify them. What requires perfect coordination weakens, while what operates with minimal assumptions continues. Food, energy, production, mobility, and capability, not because they are fashionable, but because they function when confidence is uneven. History does not repeat assets by name, it repeats behaviors. And behavior keeps drifting toward what works without ideal conditions. If the same forms of value keep resurfacing whenever systems strain, what rule has been operating quietly across every crash? By the time collapse becomes visible, the sorting has already begun. The panic is loud, but the reallocation is quiet. Across centuries, the same gravity appears. When trust thins and coordination strains, wealth does not evaporate evenly, it contracts. It moves closer to what can function without perfect alignment. Food production continues feeding people, even when markets freeze. Energy continues powering homes, even when valuations swing wildly. Shelter remains occupied, even when its quoted price becomes uncertain. Portable stores of value circulate, even when institutions hesitate. Productive assets generate output, even when financial claims wobble. Human skill continues creating exchange, even when contracts fail. These are not trends, they are residues. They are what the filter repeatedly leaves behind. At first glance, this looks obvious. Of course, necessities matter, but history is pointing to something more precise. The assets that endure are not simply important, they are structurally independent. They require fewer layers of coordination. A field grows food without a stock exchange. A skilled mechanic repairs an engine without global liquidity. A home provides shelter without a derivatives market. The more an asset depends on synchronized confidence, the more fragile it becomes under strain. The more it can operate under partial trust, the longer it survives. Crises expose coordination load. They reveal how many invisible agreements must hold for something to retain value. When too many agreements weaken at once, abstraction compresses. Value retreats toward what can stand with fewer assumptions. That is the mechanical shift. Stable eras encourage expansion as we build layers of leverage, claims, and instruments. Each layer increases efficiency, but each layer also stretches the distance between asset and function. For long periods, this works beautifully because confidence carries the structure, but stress tests remove slack. When trust narrows, the system cannot support every layer equally, so weight shifts predictably. From financial complexity to physical utility, from distant promises to immediate capability, and from valuation models to direct usefulness. This is not moral correction, it is structural compression. Systems expand outward in stability, but crises pull them back toward tangible reality, and that pull follows consistent lines. If we observe carefully across depressions, hyperinflations, wars, and financial crises, 6 forms of value keep resurfacing. Land that produces food, energy, and fuel infrastructure, shelter and essential property, portable stores of value, assets that generate real output, and human skills that solve immediate problems. Their shapes change and technology evolves, but their structural role does not. They sit closest to physical necessity and operate with minimal dependency on synchronized belief. They do not need every layer of abstraction to function. That is why they reappear, not because history prefers them, but because stress reduces systems to what works under constraint. The illusion at the beginning of every stable era is permanence. The illusion at the peak of every expansion is control. Crashes interrupt both, but they do not destroy value indiscriminately. They shift it, they compress it, and they relocate it toward what continues functioning when confidence becomes selective. This is why wealth can seem to vanish, and yet something always remains. Not everything survives, but the same categories do, across centuries, across continents, across different currencies and political systems. Because usefulness survives uncertainty longer than abstraction does. If you're someone who likes uncovering patterns that history quietly repeats, not predictions, and certainly not hype, then this is exactly what we explore here. If that sounds like you, like the video and subscribe. Across centuries, crises do not destroy value. They reveal which forms of value never depended on perfect confidence in the first place.